And so in this case, one of the techniques you can use is turning this covered call into a covered strangle. Let's look at this with 11 days to go, and let's break it down by talking about the covered call first and then explain how you can do covered strangle. So if you have a covered call, you are buying 100 shares and then you are selling a call against those shares. I call it the landlord strategy. The shares that you have equal the house that you own. It's like that. And instead of having that house or those shares sit there and do nothing for you, except potentially go up in value. Obviously, houses can go down and shares can go down in value. It doesn't feel like houses can, but some houses across the nation have went down over the last 12 months. You just don't want that asset to sit there. So if you have 100 shares, you can rent those shares out. You can rent it out on a weekly basis, like a vacation rental, like an Airbnb, or you can do the traditional route and rent it out on a monthly basis. You get to determine how you want to do that, but you are the landlord. But you're not just renting out in a completely traditional way. You're doing what is called rent to own, which is in the real estate lingo. That's where it comes from, rent to own. It's a contract, it's an option. You give somebody an option to buy your house at a certain price, but they're paying you monthly rent. And if they don't meet that certain price, then they don't get to buy your house, but they have to continue to pay you monthly rent. And that can change after each contract expiration. So that's the same thing in the open market when it comes to renting out your shares. I love this process. I love the concept of calling it the landlord strategy because you literally are renting out your asset. And so you can decide to rent it out at a very high price or a very low price or some type of mixture. In this case, what we're saying here is that we're willing to rent our shares out for the next 11 days, this 56 strike price. Someone's going to pay us $278 to rent our shares for the next 11 days on this boil. If the stock does nothing and just stays around this 53, 52 price, we're going to make $278. If the stock jumps up and it goes above and expires above the 56 strike, we're not only going to make that $278, we're going to make some additional money. We're going to make as much as $516 because we're giving the person the right to buy our house or buy our shares in this case at the 56 strike price, but we're getting that appreciation from this 53.32 all the way up to this 56 strike. So that's why we're not only going to make that 278, but we're also going to make the 516. That's the appreciation from the current price. That's a good deal. Yes, we have risk to the downside though. Technically, we have risk all the way to zero, and that would be in this example with this covered call, a risk of $5,083. This index, this boil went to zero. It's not going to do that. It's a very small, it's darn near 0% chance that's going to be the case. But technically that is our risk. It could fall $10 and it can feel like it went out of business. So if it did fall $10, we will offset those losses by $2.78. For easy math, if we received $3, we would offset that $10 drop by $3. We would be down $7. The covered call gives you some hedge, but you still have risk all the way to zero. You might want to use the covered call as a way to get monthly or weekly income because you get to always keep that premium. But you might also want to use a covered strangle to increase that monthly or weekly income. So let me explain this part. The ideal way to use a covered strangle, let's say you had a trade like this. Let's say it's in the money. Something like, let's just even say here, it's in the money. You're not going to make any more money off this for the next 4 days. or you're not going to make any more money on it, period. And it's going to expire in the next 4 days because it's already in the money and you're at the 51.5 strike and it's trading at 53.63. Can it fall back? Yes. But if it stays above here, you're not going to make any more money. But if you wanted to extend the trade, you can use the strategy that's called the covered strangle. So let me break this down. I'm just going to do it by if we were buying this back. Okay, we were buying this back. I'm just using the options so you can understand the shares is the base. That's going to stay the same. You're trying to adjust the options for credit and move your call further away than the strike price that is currently at. You want to get a better strike price so that you can make more money over the time frame you're doing it. So let's just say we're going to go out 11 days. And I wanted to move my call from that 51.5 strike, which they do not have in 11 days, right? You don't see a 51.5 right here. But I wanted to move it from there. And I want to put it a little higher than what it's currently trading at. So let's say it's currently trading just under 54, as you guys can see. I want to put it at 55, let's just say. So if I did that, before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. You can see that the debit that I'm going to have here is a 47-cent debit. Keep in mind, we already have the shares. That's the base. We still have the shares. What we're doing right now is what most people understand is rolling the call. We're moving the call from the 51.5 strike to the 55 strike from 4 days to 11 days here. That's going to be a debit. That's money's coming out of your purse, coming out of your wallet, coming out of your account. We don't want to do this for debit if we can avoid it, and we try to avoid it at all costs. We're not going to be able to 100% avoid it, but we should be close to that. And so in this case, one of the techniques you can use is turning this covered call into a covered strangle. The way you do that is that you sell a put for more than this 47 cents. That's your debit here. You sell a put for more than that 47 or 62 now that it's jumping around. So if I went down here, I decided I was going to sell this put at the 46 strike. I now have flipped the tables and have a credit of 39 cents. This can fluctuate, but I will get a credit if I do this strategy and if I do it correctly. I now turned it into a covered strangle. When you do a traditional strangle, you're selling a put and you're selling a call simultaneously. It looks like what you see right here. This is the selling of the put. This is the selling of the call. When you do a strangle, it's inherently a neutral strategy. You want it to stay in between your short strikes. So once again, the short strike of the 46 put and the short strike of the 55 call. You want it to stay in here, and this is where you win. That's a traditional strangle. A traditional strangle, you have risk all the way to zero, and you have technically unlimited risk to the upside because the call is naked. It's uncovered. But when you do a covered strangle, that already gives away what's happening. The call side is covered, and the put side is covered. The put side is covered by cash, and the call side is covered by the 100 shares that you have already. That foundation of the covered call. If you're going to do a covered strangle to reposition the call that you sold, then you have to be willing to take on additional shares. If you only had 100 shares, you must be okay with now having 200 shares. Doesn't mean you will, because it might never go back down to 46, or at least might not go down there within the next 11 days. It's only a 17% chance it's going to expire in this example below the 46 strike. But you're still collecting $48 over the next week. You still got the potential to get more money to the upside because you were at the 51.5. Now you're at the 55 strike. So you can make more over the next week if you feel like it's a bullish type of trend going on and you want to take advantage of that. And you don't want your shares to be sold away yet because they're in the money with 4 days to go. You can roll it to out of the money with 11 days to go and reposition it in a way that you can get a credit because of the put that you add, because you're turning it from a covered call to a covered strangle. We talk about this in the new book that we wrote. We encourage you guys to get it. With the safeguard strategy, you guys, everything that you can start off with if you wanted to. You can do it as a secondary concept as well. What I want you guys, I don't want you to get confused by this. I want you to understand it's still risk in this trade. It's still a covered call. You still have shares attached to this, but you're just okay with owning more shares. And you have to do that. You can't sell this put thinking that it's not going to go down or it's no chance it's going to go down. Yeah, the odds might be on your side that you're not going to have to own another 200 shares, but you don't do it if you don't have the money to do it. And you don't do it if you really don't want to own another 100 shares, I should say. But anyway, the main point of doing this conversation is showing you how you can use the cover strangle. And for me, I mostly use it as a defensive type of play or a way to give myself a little bit more room on the call side if I feel like it's the trend is going up, but my call side is already threatened or already breached or it's about to be breached, then I will do a covered strangle. So for example, I did a couple of covered strangles today and let me show you guys what I did. So I did one in this Sox L here. And so what happened in this scenario is that my call was already breached. Let me show you this here. My call was already breached with 4 days to go. So what I did was roll it out a little bit further. I think my call was at the 2050 and I moved it just another point out and I sold the put to be able to get an overall credit for it. And being okay with taking on another 100 shares of this Sox L.